Greetings. It is time for our monthly monetary creation report, where we can see whether the fundamental principles of my atom thesis continue to manifest in the form of exponentially rising money printing combined with surprisingly little inflation, because that money printing merely offsets the technological deflation that exponential technological progress diffuses into the economy. And the amount of this deflation can be quantified because it is part of a megatrend that is exponential but also tied to prior megatrends about the long-term technological future. So as always, we go to this Yardeni report and we scroll down to this chart here, which is the chart that represents the four largest central banks of the world that comprise 85 to 90% of all the world's money printing. Not 100% of it, but the vast majority of it. Now, one of the problems is that the People's Bank of China, PBOC, is becoming slower and slower in releasing their monthly data, so they have been updated only through February, whereas the Bank of Japan and the European Central Bank are updated through March, and the US Federal Reserve is updated through April. So we don't have uniformity in terms of how up-to-date each central bank's data is. However, for our long-term trends, this is only a very small inconvenience. Now, as we can see, the United States was not the largest money printer for most of the period in question, going back about 15 years. Now it is slightly ahead of the European Central Bank, again because of the Silicon Valley Bank bailout, but only slightly. The all-time high was the European Central Bank. And then China and Japan have also printed several trillion dollars. But since technological deflation is worldwide and money printing does not really know any borders and it flows over the rest of the world in short order, only the grand total of these four matters. But in the United States, if you were to watch the media, you would see daily screaming at all points over the last 14 years, claiming that the US Federal Reserve is printing so much money that we're going to have hyperinflation and things like gold will go up. That not just presumes that the United States is the only country in the world and the only country in the world that is printing money, but is further rendered more inaccurate by the fact that the United States is only about 25 to 30% of the entire world's money printing. There are times when the US was deprinting, but Japan and China were printing, enabling the net world total to keep rising. That's why only the worldwide total matters. And again, these four central banks are not 100% of the world's printing, but the vast majority of it. So if we add up the totals of the four central banks mentioned above, we get this all-important chart, which is cumulative world money printing since quantitative easing began during the 2008 crisis. And as you can see, it's rising on an exponential trend, which is exactly what one would expect due to the interconnection between technological deflation and the need to print money just to offset that technological deflation. And central banks of the world, especially the United States, print money in too narrow of a manner. They do the money printing in the form of buying simply treasuries and mortgage-backed securities. This has distorted these two asset classes to the exclusion of all others, and has utterly destroyed decision-making across the entire economy. The only way to print as much as is going to be needed in the near future, given this exponentially rising rate, is to send cash directly to people. No, this is not socialism. I say that the cash sent directly to people should be a one-for-one replacement with income tax they pay, enabling a migration towards eventually 0% income tax and negative income tax on humans, meaning that you would get money, because technological deflation, which has many names such as automation, artificial intelligence, and so forth, but it all rolls up into technological deflation, is generating the output that can finance this safety net. And I've written an entire book about that, the atom thesis. But as you can see here, this has been rising exponentially. And despite every time they try to unwind money printing, they end up having to do more because the market forces them to revert back to this trend line. Even this COVID-19 crisis, all this money printing due to COVID-19, they aren't really able to unwind it, and every time they try to unwind it, they have to revert back to printing more, as we can see over here. This line should actually be over here by now, just based on this exponential trend. Therefore, to intercept this by the end of 2024, let's say, which is only about 20 months, they would have to print this much more. So from 28.4 trillion, they would have to be at 37 trillion, about 9 trillion more. Now, of course, this is only updated through February because the China data is not current, as we saw over here. All the others are March or April. But nonetheless, on a 1-month basis, there isn't that much variation that can happen unless there's some major shock event. So just to catch up, we're talking $8, $9, $10 trillion has to be done just to get from here to here. How could they possibly be deprinting? Well, I've spoken about that on this channel many times, about how all these PhD economists that run these central banks, especially in Western countries, they're hyper-theoretical academic type people. They have no work experience in the private sector, and you would never want a surgery done on yourself by a surgeon who had only ever read books about surgery and never actually done one. Yet we have entrusted this all-important monetary policy to exactly those types of people. They're hyper-theoretical people. They are not interested in their predictions being correct and don't even seem to know what a prediction is because they report on the past as though they are predicting the future. So whenever anyone asks them about a prediction, they talk about what happened in the past, and very few people call them on that. Although there is a broad perception that PhD economists are extremely unequipped to handle the real economy and to be entrusted with these all-important monetary policy decisions. Now, because this trend is exponential, the annual growth rate, if we take the same chart over here, this annual compound growth rate has to be 16 to 24% a year. I said that in my Atom publication in early 2016, so more than 7 years ago. 16 to 24% a year would be the cruise control that offsets technological deflation from all the various exponential trends in technology, such as Moore's Law and a dozen others that I could name, all of which are interconnected but linked to these first principles of the feedback cycle between technology and economics. 16 to 24% a year. Over here, February of 2021, because of the response to the COVID-19 crisis, the annualized growth rate briefly reached 46.3%. That is a level at which even I thought there would be sustained inflation, but we have not had that, as we will see in part 2 of this video. Because when they stopped printing, they didn't have to reverse printing yet even. Just by stopping the printing, the growth rate goes back down to 0. By staying same and now negative. And even though the band has to be 16 to 24% a year, which has been proven many times, because every time they've tried to moderate or reverse money printing, they've had to do more, the same will be true again, yet they're still at minus 9.7% as a growth rate. They should be plus 16 or higher, and they're at minus 9.7. Just to get from minus 9.7 to plus 16, that represents the $8 to $10 trillion of new money printing they will have to do, as we just spoke about a minute ago. Now, if you exclude the People's Bank of China from this growth rate, this chart below over here is updated through March, and that's not very different, but this is an incomplete picture because it does not have China. Now, as we scroll down even further, we get to this chart, which is very comical in terms of U.S. hysteria about inflation. Again, the U.S. Federal Reserve is the red line over here. It is the joint lowest of the 4 major central banks in terms of money printing as a percentage of the size of its economy. Now, GDP is an annual metric, and this is a cumulative metric over 15 years, but still, this compares the relative amount of money printing by all 4 of these central banks relative to the size of their own GDP. And the U.S. is the joint lowest of the 4, despite all the hysteria you see in the media, how the Federal Reserve has printed so much money, that's why gold, which is priced worldwide, would go up. Again, the U.S. must be the only country in the world if you are a gold bug, apparently. Europe has done twice as much money printing as the United States. It has done 62.2% of the Eurozone's GDP, as opposed to just 30-something in the U.S. You would think Germans are the people most afraid of money printing and inflation, but they still have done twice as much money printing as the US. But the grand prize goes to Japan, which has done 4 times as much money printing as the United States as a percentage of its own GDP. Now, yes, most Bank of Japan money printing flows over the rest of the world and goes to the US, therefore offsetting the very low and inadequate amount of money printing that the United States does. And that's why the grand total matters, as we just spoke about a minute ago. But Japan has done 4 times as much money printing as the US in proportion to the size of its economy, and nobody claims Japan has high inflation. Even people who insist that U.S. inflation is understated and that we've had hyperinflation for the last 10 or 50 or 100 years in the U.S., even those people don't claim that Japan has had hyperinflation. So they clearly don't know what's going on. They're unable to explain how Japan could do 4 times as much money printing as the United States in proportion to the size of its economy, yet Japan does not have inflation. Now, I, of course, explained why, but if you are an inflation fearmonger or a gold bug, then these are contradictions that you're quite happy to simply ignore and change the subject around, because their opinions are not based on facts or data, but rather specifically what makes them feel good. Now we go to my quantitative easing 2020 scorecard. As you can see over here, At the start of the 2020s, as many of you know, on January 1st, 2020, I said that this decade will have a huge amount of money printing, whereas PhD economists said that all the money printing of the prior decade, the 2010s, would be reversed because that's what the textbooks written in the middle of the 20th century told them to believe. And all these PhD economists read the same textbooks and repeat them back to each other. And they believe that comprises a consensus, even though they've all just read the same outdated material. So they said the first 23 trillion would be reversed, meaning the 2020s would be at minus 23 trillion, whereas I said 50 to 100 trillion more of money printing would have to be done. 50 trillion if it is in the form of cash sent directly to people, which is what I recommend for reasons I explained earlier as well as on many other videos in this channel, or 100 trillion if done in the same concentrated manner of bond and mortgage buying, which is putting tremendous stresses on the system and causing bank failures. But if they continue on this path, they will do $100 trillion just to avoid market depressions. And here we are at the end of April of 2023, so well over 3 years into this decade, 3 years and 4 months into this decade, almost exactly 1/3 into this decade, 1/3 of the way. And remember, this is an exponential trend. And what is the total so far? About 9.1 trillion printed, give or take a little bit because of the delay in China's data. 9.1 trillion. So the start of the 2020s, January 1st, 2020, the PhD economist said minus 23 trillion would be done. I say plus 50 to 100 trillion would be done, and we are at plus 9.1. So whose prediction is more on track? Theirs or mine? Will 9.1 trillion be reversed and on top of that the first 23 trillion reversed? Or is 9.1 trillion on a path to 50 to 100? Because this is exponential. The first half of the decade will not see half of this sum. You'll see half of this sum in the first 7 to 8 years of the decade, and the second half in the remaining 2 to 3 years because of the exponential nature of this. But clearly, I'm the one who's turning out to be right, and this number would have been about the same whether COVID-19 happened or not, because COVID is over and they're trying to unwind that money printing, but the market is not letting them unwind that money printing. The market and the economy is protesting in a variety of ways, bank failures being the most recent way, because to deprint is in violation of the first principles of technology and economics, and it is anti-progress. Money printing is favorable, and it's a wonderful thing once you recognize how much money printing can be done without aberrant inflation. Now, how high is inflation based on the amount of money printing that has been done? $9.1 trillion just in 3 years and 4 months of the 2020s, and another 23 trillion done in the 2010s. For that, we go to part 2 of this video. And in this month's inflation update, we return to my measurement matrix of a multi-dimensional assessment of inflation. And this is the most holistic, comprehensive, and unriggable methodology through which to judge inflation. Longtime viewers are familiar with this, but if you're new here, I require these 3 measurements of inflation to all be above 3% before we say inflation is higher than optimal. This would still represent optimal inflation, because if inflation is too far below this level, then not only are we at risk of deflation, which causes debt defaults and so forth, but technological innovation also uses inflation as fuel, and therefore assessing all the trade-offs against each other, this is the optimal level of inflation for the United States and for any advanced economy. And that is, the US CPI's compound annual growth rate should be 3% or lower. The Goldman Sachs Commodity Index, the most important measurement of all of these 3, should be 3% or lower. And the 10-year yield of the US Treasury note should be 3% or lower. And if all 3 of these are above 3%, then inflation is higher than optimal. And that means that money printing should be paused until we're in a situation where some of these 3 are below 3% again. Also, this is convenient symmetry as well. So let us look at the Goldman Sachs Commodity Index and the 10-year US Treasury yield first, returning to the US CPI at the end. Goldman Sachs Commodity Index from the S&P website, which will be in the description box below, of course. 10-year growth rate is minus 0.46%. Minus. It is in deflation. It is negative. Despite the fact that oil has risen from $50 a barrel to $80 a barrel, and for reasons that have nothing to do with monetary creation and central bank monetary action, but rather the war between Russia and Ukraine, as well as the Biden administration in the U.S. obstructing fracking and domestic oil production. That is why oil prices have risen. Otherwise, this would be an even more deflation, but it is still at minus 0.46%. And the reason this is the most important measurement is because it is, number one, traded worldwide. This is a composite of all of these commodities that are traded worldwide: gold, oil, natural gas, silver, you name it, the worldwide prices. And it is traded on a free market, so worldwide pricing and free market trading, and therefore all the narratives about how the inflation rate is understated and so forth are debunked by the Goldman Sachs Commodity Index, because it is a composite of freely traded commodities, including those priced worldwide. Remember, a lot of people who say inflation is high happen to be in the United States, and they seem to think that the United States is the only country in the world as well. Now we go to the next measurement, the U.S. Treasury yield. 10-year U.S. Treasury yield, and it's at 3.522%. So it is above 3%. But notice how it has trouble going much higher than this. Whenever it goes to 4%, that is actually very difficult to sustain, and it dips back down. And it was below 3% for most of the last 5 years. This is a 5-year chart window. But now it's above 3%, mainly because the Federal Reserve has raised the Fed funds rate above this, creating an inverted yield curve, which I talk about in other videos on this channel. If you were to go back to the 1970s and 80s, this 10-year yield was much, much, much above 3.52%. So this is very low by historical standards, but I say that if it is above this very low bar of 3%, then it is higher than the level that I describe in my multi-dimensional inflation assessment. And now we go to the final measurement, which is the 10-year compound annual growth rate of the US CPI. This is the Bureau of Labor Statistics website of the United States, bls.gov, which is in the description box below. And this is the CPI calculation over the last 10 years plus. And to get the 10-year compound annual growth rate, you have to take this most recent number, 302, and then divide that by the number 10 years prior, 232, and that gives you the 10-year inflation rate, and the 1/10th root of that gives you the 10-year compound annual growth rate of this period. So I'll show you what the results for that is. Suffice it to say it's 2.7%, and therefore below 3%. And as you can see, despite the hysterical inflation narrative in the media, the 1-month percentage change has fallen back down substantially, as has the 2-month percentage change, the 3-month percentage change, the 6-month percentage change, and even the longest term window, the 12-month percentage change, is falling just as quickly as it rose. It is not all the way back down to this low level yet, but the average of this is clearly well below 3%, and a high peak like this has to be viewed in the context of a near deflationary period like this as well, and these two cancel each other out. Therefore, the 10-year moving average is what is important here. But there's another way to look at this, which is that table that I have shown in recent months, so let's go there. So for those of you who are familiar with this table, I take the US CPI in all of those snapshot windows that we just saw. 1 month, 2 month, 3 month, 6 month, 1 year, 2 years, 3 years, 5 years, and 10 years, and annualize each of those readings. So if a 1-month reading was just 0.1%, we take that to the 12th power. A 2-month reading has to be taken to the 6th power to get an annualized rate. A 3-month has to be taken to the 4th power, and so on. And for time windows longer than 1 year, we do the same type of exponential, except that it is a fraction. So 2 years you take the square root, 5 years you take 1/5, 10 years you take 1/10. And as you can see, the 10-year compound annual growth rate is 2.7% because there was 30.2% inflation over 10 years. Therefore, per year, the average of that is 2.7%. So you have the 5-year, 3-year, and 2-year windows accordingly. The 1-year CPI inflation rate is 5.0%, but it's been falling quickly as we saw. This peaked at 9% for a very short time, and now it's falling as fast as it rose. And a bunch of very ignorant commenters have shown up here in the past to say only the 1-year window matters. Time windows longer than 1 year and time windows shorter than 1 year don't matter at all, which is crazy. These are people who, before the 20th century, would have insisted that the Earth is flat simply because they cannot see the sphere curvature of the Earth's surface by standing on the ground. And the recent month periods are more volatile because a certain month could be 0.1% like the most recent reading. The next month could be higher, so this will move around a lot, but the general trend is back down to lower inflation as well. So contrary to the narrative, inflation is falling quickly in even the US CPI. So now we go back to my matrix for an assessment of all the measurements we looked at. So we looked at the US CPI 10-year compound annual growth rate, the Goldman Sachs Commodity Index 10-year compound annual growth rate, again, the most important and comprehensive and international measure of them all, and the 10-year US Treasury yield. And what is the answer? As we saw, the US CPI is 2.7%, so still below 3%, and it's having a lot of trouble getting above 3%. Goldman Sachs Commodity Index is in deflation. It is far, far below 3%. This is a very volatile measurement even at the 10-year compound annual growth rate level, but it's still far, far below 3%. And the only one of the three that was above 3% was the 10-year US Treasury yield, 3.52%. So only one of these three measurements is above 3%, and therefore, no, inflation is not high. I don't care what anyone says. People who actually look at data can see that inflation is not high and is not even at the optimal level. A lot of people want to debate via anecdote, and we will look again at Kartik's law of inflation to have some fun at the expense of those people. And yes, the word expense is appropriate because they believe they're overpaying for everything because they've convinced themselves that hyperinflation has been going on for the last century. So a reminder of that, Kartik's law of inflation, which is something you can learn about in detail in this video up here in the upper right-hand corner. But just for a quick recap, the longer any internet discussion about any topic continues, the probability of someone making a comment about inflation being a much greater crisis in modern society than it is approaches 100%. Furthermore, this mention will usually emerge before Godwin's law is fulfilled. Think about that. And the various categories of false statements people will make in order to scare everyone about inflation and to be in a pessimistic, data-deficient, victim mentality mode are these. So in that video that I just linked in the tile above, you can look at all 7 of these. And this is why I often say conservatives and libertarians have in fact lost their mind on the subject of inflation. They're just as obsessed with inflation without evidence of such as environmentalists are obsessed with climate change, or race agitators are obsessed with pretending that racism in the United States is much worse than it is, or radical feminists are obsessed with claiming that the patriarchy is something that is destroying all of society. Conservatives and libertarians used to be more reality-based in the United States, but that is becoming less and less true because they too have become infected by the social media method of thinking, and therefore they have lost their minds on the subject of inflation. And remember Kartik's law of inflation, because as the future progresses and money printing keeps rising exponentially, some people are never going to give up on this. Even at the technological singularity, there will be the last few conservatives and libertarians saying that we've had 200 years of hyperinflation, therefore we are poorer today than we were 200 years ago. If you like this type of content, then I encourage you to subscribe to this channel, and thank you very much for watching.